Right now, as you are watching this video, 1 billion XRP has recently been released from Ripple's escrow vault. In any other year, a supply event of this magnitude, worth nearly $2 billion, would have sent the market into a free fall. But as we enter early January 2026, the rules of the game have fundamentally changed. While retail traders remain focused on dilution fears, one of the world's largest banks, Standard Chartered, has released a research note with a price target that sounds almost impossible, $8 per XRP. That represents a 330% move from current levels. Sounds bullish, but the price isn't reacting. So the real question is this: is XRP quietly positioning for its next major move, or has the market already priced in everything? In this breakdown, we go beyond the headlines to examine on-chain data, ETF inflows, and a technical structure that suggests a significant trap may be forming. If you hold even a single XRP token, this is a video you need to watch carefully. Let's start with where XRP stands right now. As of early January, XRP is trading around the $2 level, consolidating after a strong recovery from recent volatility. What's notable is that despite major headlines and ETF developments, price action has slowed and moved into a tight range. This tells us one thing: the market is pausing, not panicking. Even at $2, XRP is still down roughly 10% year-over-year and remains well below its 2025 high near $3.50. While Bitcoin and Ethereum continue to trade closer to their cycle peaks, XRP is still showing relative underperformance. Historically, that kind of divergence has often preceded major repricing phases. To understand why, we need to look deeper into what's happening beneath the surface on the ledger. If this breakdown is helping you, subscribe for more altcoin analysis so you can make better decisions. Now let's address the so-called dump. Every month, 1 billion XRP is released from escrow. But the important question is not what gets unlocked. It's what actually reaches the market. On-chain data from early January shows that Ripple once again followed its long-established protocol, relocking a significant portion of the tokens shortly after release. In December, roughly 70% of the unlocked XRP was returned to escrow, and the most recent ledger activity confirms a very similar pattern. This means that out of 1 billion tokens, only a fraction meaningfully increases circulating supply. The fear is loud, but the actual impact remains debatable. And this matters in 2026 because for the first time, we are seeing a true supply-demand divergence. While effective supply remains controlled, ETF demand is steadily increasing. This brings us to the real institutional engine driving XRP right now, the spot ETFs. Since their launch in November, these products have recorded more than 30 consecutive days of net inflows, recently surpassing the $1.15 billion mark. To put that into perspective, XRP ETFs have significantly outperformed comparable Solana products over the same period. XRP is now firmly on the institutional radar, something that would have been unthinkable just a few years ago. Even Vanguard, the $11 trillion asset management giant, has reversed its previous stance and opened access to spot crypto ETF trading. For analyst Jeffrey Kendrick, this marks the true inflection point. ETFs transform XRP from a token into a portfolio-compatible financial instrument. Combined with regulatory clarity following the SEC's withdrawal of its appeal in late 2025, a major uncertainty has now been removed. So where does the $8 target actually come from? Standard Chartered's projection is based on what they describe as a developing liquidity crunch. As exchange balances fall toward multi-year lows, Kendrick argues that the market will eventually be forced to reprice XRP as it transitions from legal uncertainty into capital markets. It's important to be clear, this is not a short-term call. It assumes regulatory stability, genuine adoption, and sustained institutional participation through upcoming legislation like the Clarity Act, which is scheduled for Senate consideration this month. If passed, it would formally define regulatory oversight between the SEC and the CFTC. That shift moves XRP's narrative away from speculation and toward fundamentals. But before any of that matters, the technical structure needs to hold. Let's look at the technical picture. XRP remains coiled in a tight consolidation range, with immediate support near $1.82. On the upside, resistance sits between $2 and roughly $2.11. A decisive breakout above this zone could trigger momentum toward the mid-$2 range. However, XRP continues to trade below key moving averages, including the 50-day EMA near $2.05. If the 182 level fails, the downside risk extends toward the $1.25 region. In simple terms, XRP is coiled, not broken. It's a high-profile asset in a waiting phase. Short-term? Expect patience. Long-term? The broader narrative remains intact. I want to hear your view. Do you think XRP is being suppressed, or is the market simply being realistic? Let me know in the comments. And if you want more clear, data-driven altcoin analysis like this, make sure you're subscribed. I'll see you in the next breakdown.